New College. I'm going to invite you back sometime to see the rest of the campus. New College exists to provide the brightest minds in Florida with a world-class education. And we're very proud of our students. We're also very proud, that world-class part, we're very proud of our partnership with the GIC, the Global Interdependence Center, and also Cumberland Advisors, who's been David Kotok and Sharon Pryzant in particular, who've been deeply involved in this center. And of course, are deeply involved with all the sort of global craziness they have to deal with that's going on now, but it really enhances the education we offer here. So thank you for being here, and with no further ado, I'm handing you over to the inimitable David Kotok.
Thank you very much, Don. This is, as some know, this is our 4th or 5th year where the Global Interdependence Center has partnered with New College and brought a discussion of finance and economics. And the world is a crazy place, but this afternoon we're going to have all the craze relieved by 2 distinguished speakers. Let me do some housekeeping things, which I must do. We have sponsors. Events like this don't happen without sponsors. So Cumberland Advisors, our firm, sponsors, and there's a bunch of Cumberland folks here. I now can't see them. Williams Parker, the law firm in Sarasota. They sponsor every year. They are magnificent lawyers. I mean it. I'm going to say it, but I mean it. And Carla Smith is here. Where's Carla? Carla, Plush Smith, CPAs. Look, lawyers, CPAs, the Federal Reserve. They're winning, practically. So thank you, Carla. And thank you, John Wagner, whether you're here or not, at Williams and Park. On March the 4th, Cumberland is partnering with State Street Global Advisors to have a full discussion at the Hyatt on ETFs and ETF strategies. There's a flyer on a table out in the corner that has a description, and anybody who wishes is most welcome. It's kind of a special event. I don't know there's been one like that in Sarasota, but anyway, you are all welcome if you're interested in financial markets, economics, the stock market, and ETFs. We have Global Interdependence Center representatives here for 2 reasons. You'll hear the second one in a minute. But Jill Fornito manages everything you need to know about the Global Interdependence Center. She knows. And she can tell you about February 18th at the New York Athletic Club, if you choose to go north because you don't know what paradise is like all the time. A session on commodities. We have a meeting in Paris on March 23rd. You are most welcome. Jill can give you details. We have a meeting in Philadelphia on the Persian Gulf, Gulf states, and Saudi Arabia. A conference on cyber security on April 28th. Is there one of these out there? Handout? There are flyers out there. All the details, Jackson Hole in July, and so forth and so on. Interdependence.org, and everybody here is invited. Participate, come as you wish. We are happy to have you. Now we have a special treat because we have some GIC board members who are in the room. And to understand that, GIC board members, Global Interdependence Center board members, participate at their own expense, or they have their companies support them, or their businesses support them. They are from around the world, and their purpose is to have a neutral convener of dialogue about controversial or open issues. And I would like all the GIC board members and Jill to please stand. Michael Drury, who is the chief economist at McVane Trading in Memphis, is the chairman of the Global Interdependence Center. Now, they happen to be here for a second meeting. This is the second time in Sarasota for the National Business Economics Issues Council. And this is, what is it, David, 114? Large. 100 plus meetings. It's a group that meets around the world, mostly in the United States. And it meets 4 times a year. And for some strange reason, the winter meeting is here. So, NB is a group that you don't hear much about. It meets privately. We represent institutions from around the United States. I asked Dave Burson, who is the chief economist at Nationwide Insurance, and Michael Drury, who's the chief economist at McVane Trading. Renee Ucell is a member of NB. Dave Altig, when we get a rope around him, we'll try to get him. Stu Hoffman, the chief economist at PNC, and so forth. It's a very distinguished group. And I'm going to ask every NB member in the room to please stand.
Oh, dear.
A very distinguished public servant who stood is Rudy Penner. In the ancient times, he ran the budget of the United States of America. And thank you for your service, Rudy. Okay, enough of me. We have 2 distinguished speakers. We will go in sequence, then we'll drag the chairs to the middle, and we'll have a Q&A session, and we will make a hard stop at 7 o'clock. Both of them have been supporters and participants in Global Interdependence Center events in and outside of the United States. Renee and I haven't seen each other since either Prague or Tallinn, Estonia. We were talking about it. I don't remember the last time. Both of them have very distinguished economic careers. You saw all of that in the flyers. Renee is the director of research at the Federal Reserve Bank of Dallas. Her specialty is energy. Now, I know no one here is interested in energy, but we'll get a little clarity there. Dave Altig, macroeconomics, monetary policy, director of research at the Atlanta Fed. So we're in for a real treat, and we'll have time for some Q&A after. And Renee, you're going to go first.
Yep.
Okay. Renee Ucell, please.
Good afternoon. Can you hear me? All right. So when I accepted Dave's invitation to talk early last year, we had a totally different environment in the energy industry. And so here we are. Oil prices were $100, then had been around $100 for maybe 4 years running. And we expected them to stay that way. But, of course, here we are, and things have changed. So oil price, if you remember, in June was $107, plunged to below 50 rather. And currently it's around 47, 49 today it was, but it's more than a 50% decline, brought about by ample supply and weak demand. So when prices started falling in June, the OPEC meeting was in November, and everybody expected OPEC to come in and cut production. But that didn't happen. In fact, OPEC decided they weren't going to do anything. And after the November meeting, the next day, prices fell by another $7 right away. So here we are. Now, the other picture, the other line right here is natural gas, that times 10, so that we could put it in the same chart. And that's right now, actually, this was 2 weeks ago or a week ago. Right now, yesterday's price was $2.68. So natural gas has also fallen quite a bit, but with no fanfare, actually, for gas. And it's basically natural gas is very weather-driven. So this is sort of a warmer weather. Even though we're having these huge storms up east, the weather overall has been pretty warm. And so that's why gas is so low. But I'm going to talk about oil in this particular talk. So here's what I'm going to do. I'm going to talk about how we got to this low price environment, look at world oil supply and demand balance, then discuss the impact on the US economy, discuss the impact on state economies, and then sort of give you a couple of my thoughts on where we go from here. So, okay. So here you see consumption growth, world consumption growth. This is quarterly growth year over year, 2013, 2014. And you can see the sort of deceleration in growth in the second half of 2013 and first half of 2014. Then it started sort of picking back up. The deceleration was mainly a result of weak demand coming from Asia and from Europe. Now I'm going to add to this, oh, rather, before I get there, let's sort of look at the details of it. So in 2014, you see that OECD demand was actually negative. That was actually Japan and Europe. Demand in the US was relatively flat, but didn't offset that decline in Europe and Japan. And then here is FSU and Eastern Europe. And you can see that that declined quite a bit. And those are, of course, the troubles that Russia's economy is having after the Ukrainian crisis and the sanctions. And here is the growth in non-OECD Asia. And that's where demand growth has been traditionally in the past, say, 10 years. And we see that here in 2014, that was the highest, where the highest growth was coming from. Now, so overall growth went up about 900,000 barrels per day. So that's not that much, but it's still, it's quite slight, but it's not zero. It was 0.9 million barrels per day. However, the important point is this supply and demand mismatch. What I've added here is this non-OPEC production growth. And that is quarterly, again, year over year. And you can see the difference between the, the demand and supply right here. And it sort of got wider, that imbalance got wider as we went forward. So let me add, and where this is coming from is really North America. The bulk of the supply growth was coming from North America and largely from the US. About 2 million barrels every year from the US growth. So now I'm going to add OPEC to this. And so the greens are OPEC, and you see that OPEC hasn't been a major player in terms of year-over-year production growth. But here in the third quarter, and in the fourth quarter, you see OPEC coming in and adding to that supply-demand imbalance. And basically, this is Libya and Iraq, and I'll show you that a little bit later. So let me add the oil price on this. And this is the change in the oil price, WTI, and it did what you would expect. When you have a demand-supply imbalance like that, oil prices declined. And one point to make here is that in the first half of 2014, we didn't see much of a decline in oil prices. And the reason was, even though you see a supply-demand mismatch in terms of growth, not everything is in this picture. This is final demand, so it doesn't include China's increase in inventories, oil inventories. So China was buying oil and putting it into their stocks, both strategic and commercial, and that doesn't show in this in the demand picture, but it's there. So that was sort of propping up the oil price in the first half. Okay, so I said Libya and Iraq. Well, Libya and Iraq, production has been quite unstable from these two countries, but I think part of the fall in oil prices is due to this unexpected increase in Libyan and Iraqi oil production in the second half of 2014. So if you will look at Libya, it was really unstable because of the sectarian violence. First half, March, there was very little growth, very little output from their oil fields, but it started coming back up and actually started increasing in July. And by October, Libya was producing nearly 1 million barrels per day, about 900,000 per day. But then it declined a little bit in November and then was halved in December. But Iraqi output came in to offset that decline. So Iraq, again, very unstable because of the problems they've had with the sectarian violence, especially in the north with ISIS. So in the south, those southern fields were producing pretty okay, but in the north they had a lot of problems. And another problem was that the Kurdish government and the central Iraqi government couldn't agree on how to share their oil revenues, and especially on their export revenues. So this December, they actually came to an agreement. And so in December, Iraqi output was 3.7 million barrels per day. And that is the highest that we've seen from Iraq in the last 35 years. So these two, I think, oil producing countries, we saw a huge increase in their output, which was largely unexpected. And that sort of caused, I think, some of the decline in oil prices. Okay, so weak global demand was also a factor, of course, but I'm going to argue that it was actually supply and not demand. And this slide is sort of consistent with that story, because what you see here are commodity indexes, commodity price indexes. So you see energy right here, and then you see industrial metals and all non-energy. And you can see that the energy actually fell quite a bit more, significantly more than the other commodity indexes. And just to sort of bolster that argument, I will show you what happened in 2008. And in 2008, you saw all these indexes coming down in a more similar magnitude than you're seeing right now. And this is, of course, demand-driven. It was the beginning of the Great Recession. So they did move together. They were coming back. So I think this time around, it's more supply-driven than demand-driven. Okay, so what impact does this decline in oil prices have on the shale boom, on the U.S. economy? So first I'm going to look at how it has affected our energy industry. Then I'll look at what it means for the U.S. economy overall. So here you see oil and gas production in the U.S. This is yearly production going back to 1920. And in mid-January of this year, we were producing 9.2 million barrels per day. So that is the highest that we've seen in the U.S. since over here somewhere, 1986, before oil production went south after that first oil bust, if you remember, 1986. And we haven't seen this type of production since 1974. 1970 was our record high, about 10 million barrels, and so this is 9.2 million barrels. Now, another point to make here is since 2010, so here's the shale revolution. 2010 to current, we saw about 3.8 million barrels per day increase in those 4 years or 5 years. And that increase, just that increase, is more output than any other country producing oil, with the exception of China, Saudi Arabia, and Russia. So just that increase in 4 years, we actually produced more than any of these, any producing country except for those three. Excuse me. So for gas output has been growing quite strongly also. You can see that. And the record for gas was 1970 also. But since 2010, every year has been a record production year for natural gas. In 1970, we were producing about 22.6 TCF. We are now producing 28.6 TCF. So we're producing a lot of gas. And again, it's from the shale. So where is the production coming from? So a lot of states produce oil from shale. And you can see on the left-hand side over there, those are some of the smaller producers. And Oklahoma, New Mexico, Wyoming, Colorado, those are sort of, they are the larger of the smaller producers. But the biggest producers, of course, are North Dakota and Texas. North Dakota more than tripled its production since 2010, producing about 1.2 million barrels per day. And then Texas is almost tripled, nearly 3.4 million barrels per day. And just sort of compare, you know, if Texas were a country, and Texans like to think like this, if Texas were a country, we would be the 7th largest oil producing country in the world. So that's a lot of oil coming out of Texas, 3.4 million barrels per day. Excuse me. All right, so what has happened to this production from production from shale? Well, with the decline in oil prices, we're seeing a precipitous decline in rig count in these large producing states. So you see North Dakota as the blue is North Dakota, Texas is red, and U.S. less Texas and North Dakota is the green. And you see the rig count falling. The U.S. rig count just in January fell by 300 rigs, and about 157 of those were from Texas. And about 22 were in North Dakota. That's about a decline of 15 to 18% in all these areas. So in Texas, the interesting thing is the largest decline was in the Permian Basin, but it was in the vertical wells, the traditional vertical wells. So it wasn't the horizontal wells, but the vertical wells that saw the decline, because these are more expensive. And so there's a cost advantage to the horizontal wells, and we haven't seen a decline in the horizontal wells yet in the Permian. I'm sorry. That's why I have this water. So what has happened to oil production then? We see this decline in oil prices, we see the decline in the rig count. Well, we haven't seen a decline in oil production yet. So this is now weekly data, and this is from the second week of January 15. And if you look at oil, which is this blue line here, you don't see a decline in the middle January yet. And then we actually have one more week of data, third week, and it flattened out a little bit, but still has not declined. Relatively flat. So how's that? Well, part of it is because these current rigs are quite efficient, and unlike the traditional vertical wells, the horizontal wells are very productive. So, and you see here the efficiency of these wells has increased with time. So if you look at the red and the blue, the Bakken and the Eagle Ford, so the Eagle Ford is a major producing region in Texas, South Texas, and the Permian is also in Texas. They've gone from about 200 barrels per well to about 500 barrels per well since January of 11. Now, the Permian is older, somewhat older play, and you see that it's not as efficient. The wells are not as efficient. So the EIA, which is the Department of Energy's Energy Information Administration, estimates that to keep production stable in the Bakken, you need about 120 rigs, and you need about 200 rigs in the Eagle Ford, sort of keep production stable. So where do we go as the rig count goes down? I don't think we're going to see increase in production, but it may not decline as drastically as we think until you pass that minimum that the Energy Administration is talking about. Now, one thing to remember here is these wells are very productive, but they have really high decline rates. So after the first year or two, they decline really fast, so you have to really drill a lot more to keep that production going. So you have to keep that in mind. Even though they're prolific, they're very productive, very high decline rates. So how low can these prices go before activity slows down? So here are break-even costs for some of these producing regions. And the break-even costs differ a lot from basin to basin, but they also differ from within the basins. So it's quite different depending on the geology. The North Dakota Department of Mineral Resources published a report quite recently, and they have estimated the Bakken break-evens, and they're talking about a 10% rate of return on this, between $28 to $85 per barrel. Now, the report also said that the current prices, and this report came out about 2 months ago, current prices are below break-even for all but two of the producing counties in the Bakken, but these two counties produce about 50% of the oil. So the EIA also reported that most of the production in the Bakken remains profitable at or below $42 per barrel. And the most productive county, which is McKenzie, is the one with the $28 per barrel break even. Now, we don't have as much research, unfortunately, on the Eagle Ford or the Permian, but here are the ranges for those areas. The Eagle Ford, 46 to 80, depending on where you are, and for the Permian, $52 to $75 as break even. Okay, so what does this mean for the U.S.? We looked at how energy activity was affected by lower oil prices. How is the overall U.S. economy affected? Well, the overall U.S. economy benefits from lower oil prices. With low oil prices, the consumer has more disposable income. Gasoline, if you sort of remember, gasoline and diesel make up about 65% of oil consumption. And so the consumer has a lot more money in their pocket. They can do other things. They can go buy retail, spend the money anywhere else. And the Department of Energy estimates that with current prices, each household is going to be paying about $550 less for gasoline than they did last year. So that's an extra $550 in every household's pocket. What else? Well, this penny decline, that's sort of back of the envelope calculation. The lower oil price also reduces the cost of energy to firms, but of course it reduces the profitability of producing oil. And so you've heard of a lot of layoffs, I'm sure. Every day in Texas we hear of different companies laying off. Some of the larger companies like Schlumberger and Baker Hughes are laying off thousands of people. And then you've also heard how the capital expenditures are being cut by companies also, about 20 to 30, sometimes 40% cut in capital expenditures for this year. So all this is hurting those companies. And then, of course, any sector that benefited from the oil boom is going to be hurt also. And what am I talking about? For example, Midland, Odessa, construction sector, leisure and hospitality, transportation, all those sectors are going to be affected negatively as oil activity winds down. Now, so depending on what study you look at, a 50% decline in oil prices can lead to a 0.3 to 1% increase in GDP. And this sort of depends on what study you're looking at. The lower, well, I'll just leave it at that. Those, depending on what study, you can get from 1.3 to 1% increase, and that's if the price stays constant or at these low prices for about a year, and this is a yearly estimate. Of course, headline inflation also falls with lower oil prices. Okay, so let me talk a little bit about the states. Whether a state is hurt or helped depends on whether you're a producer or not, whether you're a producer or a consumer. And here are the major producers in the states. So about 2 years ago, a colleague of mine, Steve Brown, and I had done a study for the Council on Foreign Relations looking at the impact of lower oil prices on the states. And we found that 8 states are hurt by falling oil prices. And you see those states here: Alaska, Louisiana, North Dakota, New Mexico, Oklahoma, Texas, West Virginia, and Wyoming. What are these bars? They are the share of the 5 energy-related industries in the state. So these energy-related industries are oil and gas operations, which is the blue, refining, petrochemicals, oil field equipment manufacturing, and coal mining. So if you look at this, you see that Wyoming has the highest share of energy-related employment, and then Alaska has a quite high share. Then Texas and Louisiana, for example, are somewhat more diverse because they have not only the oil and gas operations, but they also have refining and petrochemicals. And when oil prices go down, all these industries, with the exception of refining, are hurt. So the refiners are better off, but the rest of them are actually hurt. Again, looking at this, you see how this share went up from 2000 to 2013 with the shale boom, and the state with the highest increase is North Dakota, as you can see over here. this is a summary of our study. Basically, it shows which states are hurt, which states are benefiting. And so the states in green are the states that are helped by low oil prices, and the ones in red are the ones that are hurt by low oil prices. And the darker the red, the worse the impact. So the state that's hurt the most is Wyoming, and so those are those 8 states that I showed you earlier. Now, what are those numbers? That's the impact on employment of a 50% decline in oil prices. So it says, for Texas, for example, a 50% decline in oil prices will lower Texas employment by about 1.2%. What does that mean? For Texas, I can give you Texas since we've been looking at these numbers for a while, means about 140,000 decline in jobs in Texas. Now, it doesn't mean Texas is going to go into recession. It means that you're going to get 140,000 less than you would have. Last year, Texas added about 400,000 jobs, so we're looking at a slower growth rate, basically, for Texas for 2015. So let me give you a couple of caveats with this, though. First of all, when we did this model was done to analyze the impact of oil price increases, not decreases. But it's a symmetric model, so the calculated numbers are the same. However, if you look at the literature, there is a literature out there that says economy is hurt more when prices go up than the benefits when prices go down. So it's not symmetric. So you sort of take these numbers with a grain of salt, just sort of, they do show which states would slow and which states will not, and sort of the magnitudes, even though you should maybe take the exact magnitude with a grain of salt. But overall, I think it sort of shows you the general picture. Now, another way the states are hurt, of course, is the state severance taxes. The states that produce get a lot of taxes from oil and gas severance taxes. And some states, of course, are more dependent than others. You see here, Alaska gets 80% of their tax revenues from oil and gas. North Dakota, about 50%, and Wyoming, about 40%. States that are more diversified, like Texas, get only about 9% of their total tax revenues from oil and gas. But even that is a hit. Last year, for example, or 2013, these are 2013 numbers, Texas got $4.5 billion from severance taxes, so it's still quite a big chunk that's now going to be halved because oil prices are halved and you're going to see probably lower production. All right, so where do we go from here? Well, the one no-no in forecasting is you never put a number and a date at the same time. So I'm not going to give you a forecast. So here's from the EIA what they think, again, the Department of Energy, what they think is going to happen to oil consumption in 2015. And you see here that they predict, that the OECD is going to grow a little bit less. The decline in the former Soviet Union, from a small increase in consumption, you're going to see a decline in consumption in the Soviet Union. The Asian countries, even though, again, that's where most of the consumption growth is coming from, that's going to be slowing a little bit or decelerating, and that's mainly China, China's economy slowing. So in terms of numbers, they're predicting that it's going to be about 1 million barrels per day growth. So last year was 900, this year is 1 million, it's just slightly higher. The thing is, this is the current assumptions. This is with current assumptions. These are revised as the year progresses, so may not stay where you see it now. And so what does this mean about the price? Well, here, again, this is not my forecast. So I'm showing you what the market thinks and what the Department of Energy is forecasting right now for 2015. The Energy Department starts out with a $46 price in January, and then it goes up to, let's see, 67 by the end of the year. If you look at the market futures is lower than that. That's this green line, and they end up with about $56 at the end of the year. Those dotted lines are what we call confidence bands. So they are, So the oil price with 95% probability will be within those bands. But if you look at those bands, I mean, it's pretty wide. So it means there's a lot of uncertainty out there. Okay, so let me just sum up. So the market will adjust to this low-priced environment. We're going to see a contraction of supply, and we'll see an increase in demand. But demand is not very sensitive to price changes in the short run. So it's going to take some time for demand to adjust. In the long run, it's more sensitive, but short run is not. So you're going to see people buying, bigger cars, driving more, gas-guzzling cars and trucks. And you've seen that already in Texas. A lot more trucks are being sold. The IMF has lowered its growth forecast for this year, but it's still showing growth for the economy. It's about 3.5% for 2015, expecting 3.7% for 2016. So there's still growth, and oil prices will rise. Now, when they will rise, well, that's the question. So I'll give you a couple of factors on, that will affect some of these prices. One is there's a lot of oil that's going into inventory right now. If you look at stocks, inventories, they're rising all over the world. And so this is not just on land, but also floating inventory. So people put them in tankers, and so there's a lot of floating inventory. So once that inventory gets filled, then you're going to see big pressure, downward pressure on prices if that happens. The other is, so I talked about Iraq, and Iraq was a surprise coming in like that. Before all the troubles with ISIS started, Iraq was claiming that they would be producing 4 to 4.5 million barrels per day. Well, now they're at 3.7. So if they go to 4 or 4.5, that will put a lot of downward pressure on prices also. And one other point to make, and this is just for the short run, is refineries are going to go into maintenance season in March. So you're going to see sort of a weakening of prices maybe in the spring because of that. But supply is more elastic now. So the horizontal wells that are being drilled are actually, you can shut them off, and then you can bring them back in about a week, not a week maybe, but a couple of weeks. Unlike the traditional wells, when you shut off a traditional well, vertical well, it took more than a year to bring that back. So if prices go up, the supply response is going to be quite a bit swifter than it was in the past. So, of course, there's a lot of uncertainty out there, and I'm going to list a couple of these risks. The outlook for the European and Chinese economies, turmoil in the oil-producing regions in the Middle East, it's going on. We'll see how that affects oil production going forward. And last but not least is that the oil market is actually not really a competitive market. I mean, it's behaving like a competitive market now. OPEC has not had the discipline to behave like a cartel, but you have to keep in mind, in the back of your mind, that Saudi Arabia has 2 million barrels of excess capacity. So they are the only country in the world that has excess capacity. So it's not, so just sort of keep that at the back of your mind. Now, as far as the U.S. goes, we are in a sweet spot, and Dave's going to talk about that. Low oil prices are helping us, and so Dave will come and tell us how well off we are, maybe, right?
I don't get the nice dramatic effect with the lights going down. Got the presentation? It's nice to be here, a little intimidating. There's a lot of economists up here. So the answer is yes and no. So you might think that I'm going to do the usual sort of economist trick and equivocate. But I'm not doing that. This is the answer. The first question is, are interest rates going up? And by interest rates, I'm going to be kind of specialized about that and mean the policy rate that the Fed sets. The answer, are they going up this year? Yes. Second question, are they going a lot? No. This is probably a good moment to say the views that I express are not necessarily those of the Federal Reserve.
But I'm hardly alone among Fed people, many of them much more important than I am. One of them is my boss, Dennis Hart, president of the Atlanta Fed, who has basically said 2015 is the year, but don't get too carried away. We're not going to be too aggressive. So basically, I'm just going to tell the tale of the yes and no through our forecast, through the forecast of the Atlanta Fed. Now, as I said, this is stinking economist. And I'm not going to say anything new to them or probably you. We're all going to say about the same thing. But I may be unique in this crowd as I'm probably the only one who currently can screw you up by acting on that forecast. So I got that going for me. Which one is forward before I screw this up? Top one? All right, so before I do that, we're going to take a little history trip. History trip through the recovery and a bunch of forecasts in the recovery. Recovery started from the Great Recession about the middle of 2009. So I'll start in 2010, the first full year of the recovery, where the economy grew at little under 3%. Now, if you remember back to that time, the great debate of the moment was whether we were going to see a V-shaped recovery or what came to be known as the Nike swoosh recovery. Really sort of shallow and protracted, and 2010 basically answered that question. It was not going to be a V-shaped recovery. It wasn't going to be like the other deep and severe recessions in the post-World War II period. It was just this looked like it was going to be a long slog. I put an FOMC projection bit down here, but we weren't telling anybody what we were thinking at the time, so it's not applicable for that year. But we started in 2011, and even though by the end of 2010, a lot of people said, well, this is sort of a Nike swoosh deal, we were still thinking something in the neighborhood of 3%. That was the midpoint of the FOMC projection. So a lot of you know, there really is no such thing as an FOMC projection. There's like 17 or 19 people or however many it is at the time, depending on whether Senate's gotten around to kind of confirming a governor to sit in Washington. And they all give their own forecast. So I'm just picking out the middle, the midpoint of those forecasts, which really have been pretty tight through most of this recovery. Not a whole lot of disagreement. So we were thinking 3%. We got under 2. Hope Springs Eternal in 2012, 3%. We got under 2. We're not that stupid. So the next year we settled down, 2.6, and we got 3. So here's where we are now. We're going to say 3% again. You get the pattern. We got 2.5%, although that 2.5%, as we all know, is pretty misleading. It included the first quarter of last year, the terrible weather, Snowmageddon in Atlanta, where my wife spent 18 hours in a car on the freeways of Atlanta, which is my usual commute, actually. But that day, she happened to be in the car. So it was a terrible first quarter, and it's been pretty good since. A little bit weaker, we know now, in the fourth quarter, but we're not going to get too worried about that. So what's the forecast for next year? Yeah. For the next 2 years, for example, as a matter of fact. So we're nothing if not consistent, but we really basically have what's looking like a 3% economy for 2 years running now. Finally, something that looks a little bit like a recovery is set in and is going to continue above what we suspect is the long-term growth rate of the economy now for a couple of years. Now, again, so we had a consumption report today. The consumer maybe looked a little weaker. All of the excitement we had built off of the October, November numbers, but it really changed anybody's mind much about anything. And everything Monet was talking about is really a big part of that story. So I'll just sort of tell you how we're processing things. So this is sort of a key. And look, forecasts are what they are. Forecasts aren't really, this is my story, I'm going to stick to it. Forecasts aren't really sort of so much about whether you get the number exactly right, which is a good thing, because we never do, but whether you get the narrative essentially right. And here at the end of the year, we found something kind of interesting. So here's two series, the growth of investment, basically, fixed investment, so not including inventories, for example, and the growth of consumer spending, that's the dark blue line. And near the end of the year here, what we saw was consumers stepping up as business investment sort of stepped down. Now, that's only one quarter, doesn't necessarily mean a lot, but I think it is a key part of this oil energy story. So here's some experiments we did. Here's a couple of experiments. So start off assuming normal is $100 a barrel. I think that's the number. I'm just really kind of making that up. But it's something near $100. And then ask, well, what happens in the economy if it falls to about $70? And what happens if it falls to about $50? That's about the 50% Monet was referring to. And here is a picture of what, in our analysis, happens to business spending on structures, machines, software, and all that sort of stuff. And the key point is, so there's a general sort of rule I learned in graduate school, there's zero, and below zero is usually not good. So below zero means it's worse than it would have been at $100 a barrel. Why? Well, for all the things, what Monet was just talking about. We sort of come to learn through a lot of research about these things that the production of oil out of existing wells is pretty insensitive to changes in price. But investment in structures to get oil and gas is very sensitive. So this is all sort of the who are the losers bit showing up here with this decline in energy prices. So this basically says, you get 2 percentage points in fixed investment off of what it normally would otherwise be doing at $100 a barrel if the price fell to $50 a barrel. So it's non-trivial. There is a hit to investment spending overall, the economy, at least for a while, with these very dramatic reductions in the price of oil. Here's what happens to consumer spending. And in the end, it's a pretty good picture. But again, Monet alluded to this. It takes a while. It doesn't happen right away before you start getting these positive developments on consumer spending. So for a while, you got this race between this kind of negative effect on business spending, on investment, and this positive effect on consumer spending before you really begin to feel in the economy that the impact of these falling energy prices is a clear. According to our estimates, here's 2015, so that's basically the relevant year, depending on whether you end up with $50 or whether you end up with $70. We add 0.4 to a full percentage point to GDP this coming year. So we're taking on board actually the energy prices that have occurred so far, and assuming they more or less sort of stick at some lower level. So instead of 3% growth, that would mean if we were otherwise going to get 3%, we get 4% in the best case scenario here. It's an unambiguous positive in some sense, in a net sense, but depending on whether the price falls further or whether it retreats a little bit, changes the dynamics and the timing of all of this, and it's big. It's a big positive eventually, but in the short run, it's not so obvious. That 3% that we wrote down for 2015, and those are the Atlanta Fed forecasts, are basically assuming something in between these two scenarios. along with that relatively positive outlook for growth is a continued positive outlook for unemployment. So when we do these things for our part of the exercise of the summary of economic projections, FOMC forecast, we're asked to do GDP growth, unemployment, and inflation. There's GDP growth as we see it today. Not necessarily our official forecast for the FOMC, but as we see it today, and unemployment rate. So unemployment rate, I've written down 5.2. It really probably should be 5.3, 5.2. And it's really funny that I'm making a distinction between 1/10 of a percentage point, but I am. 5.3 to 5.2 by the end of this year. And why is that number important? That number is important because that's about normal. That's about our estimate of normal. So a forecast that looks like this says after 2 years of about 3% growth that we've had, another year of 3% growth, we're going to get to the point where finally, by at least the measure of the official unemployment statistic, we're back where we should be. And if anything, that's a bit, perhaps, of an understatement of how much improvement we'll see on the unemployment rate, because we haven't got that right yet. Here's the unemployment rate as it stands today, 5.6, 5.7, depending on how you want to round. Here's the projection of where the unemployment rate would be in December 2013. So if you remember back to 2013, that was when Ben Bernanke said, you know what, we're going to start backing off of QE3. We had been in the practice of buying up a bunch of mortgage-backed securities, and we did it the old-fashioned way. We printed the money to do it. So he said, time to stop. We're going to stop. We're on our way to ending this program. And if you remember the beginning of the program said, we're going to print money. That really wasn't sort of the official words, but that's what we said. We're going to print money, and we're going to keep doing it until we see substantial improvement in the labor market. And you can see what at the time we thought substantial improvement in the labor market was. We thought with QE3, it would be the end of 2016 before we would see the unemployment rate that we've already seen today, as of December. And in December, when we were projecting what it would be over the coming year, we're already lower than what we thought we would be at that time. In real time, the unemployment performance was better than what we were thinking. So if we erred for a long time on the optimistic side of GDP growth, we've definitely erred on the pessimistic side of the unemployment rate. So you'd think, so here we go. Now looks like we got a run rate of about 3% GDP growth at least. There's global nervousness and anxiety and lots of things that could go wrong, but we got looming in the background this huge energy story, which clearly brings with it upside risk, the possibility that we are still being too pessimistic. So why am I not saying we're going to raise rates tomorrow? Why am I not sitting here explaining to you why we didn't raise rates in January? And why am I saying slow rather than, yeah, we're going to raise rates and would you like to see 5%? Pick your number. Well, here's the other piece of the forecast, the inflation bit. So this is headline inflation. I'm not doing any kind of Cirque du Soleil kind of acrobatics to get an inflation number. I'm not subtracting out your mother's shoes and all that sort of stuff. The headline inflation rate. And we know what's going to happen. The energy stuff is going to give us a very weak number. But do not fear. It's temporary. And by a year out, will be almost right on that 2% objective that the Federal Open Market Committee says is motivating our behavior. Anything below 2%, anything substantially below 2% is too low. Not time to raise rates in that environment. 2% is what we're aiming for. Now here's a little trick, little mysterious little wrinkle on these projections. When you see one of these forecasts from any Federal Reserve Bank or any governor or in the summary of economic projections that we issue quarterly after a Federal Open Market Committee meeting, we are told what we are supposed to assume about monetary policy when we make those projections. Well, we're sort of told. We're told, tell us what you think GDP is going to be. Tell us what you think unemployment is going to be. Tell us what you think inflation is going to be under the assumption of appropriate monetary policy. Now, we're not told what that is. We get to make it up. We get to make up what appropriate monetary policy is. Okay, now let's put all this together. The Federal Open Market Committee has said they want 2% inflation. We only do our job right if we, over the medium term, get 2% inflation. We're told to forecast inflation under the assumption that we do our job right. Under what circumstance am I not going to write down 2%? And I haven't found one yet. So, is this a forecast? Well, I don't know. It's a hope. And it's a hope that hasn't really borne out recently. Here's our objective, 2%, and for 2.5 years or so, we've been running, almost any way you want to measure it, well south of 2%. Though the unemployment rate, we think, is going to be at mandate consistent levels. So remember, the Federal Open Market Committee is mandated by law to pursue maximum sustainable growth in employment and price stability defined as, get to 2% inflation on average over time. And it looks like we're getting there, sort of, on the employment part, not so much on the inflation part. But we're supposed to care about both of those things, so you trade them off against each other to some extent sometimes. So how do we get a handle on how close we are? Well, here's something that was suggested by President Jim Bullard from the Federal Reserve Bank of St. Louis. He said, look, this is really pretty simple. We learned this in school. You're not supposed to be very far from 2%, so measure how far you are from 2% on inflation. You're supposed to be close to whatever your view is of what normal in the labor market is. So I told you, something like 5.2% unemployment is sort of our guess at the moment. So take the difference between those two things, square them so that you really get penalized numerically in this measure I'm going to tell you about if you deviate from where you're supposed to be, and then add those two numbers up. So in such a world, look, what are you shooting for? Here you're shooting for 0. 0 is when inflation equals 2% and the unemployment rate equals 5.2 or whatever you think it ought to be. And then higher numbers are bad in this case. So he showed a picture of this in a speech he gave. So here's this picture updated to this morning. And you can see it is now down at levels that are pretty consistent. You couldn't really distinguish this from normal periods. The gray areas are recessions. And you see the big blow up and how badly we're doing, largely because the unemployment rate is blowing up during the Great Recession, and this slow trek down to something that looks like, almost by President Bullard's measure, success. In fact, close enough maybe, it's time to pull the trigger, raise rates, get your CDs, paying some money. Well, not so fast. because this is predicated on the assumption that the right measure of performance in the labor market is the regular old unemployment rate. And I've come to believe that's not the right measure. So most of you know this. How does the unemployment statistic work? Someone knocks on your door and says, you got a job? And if you say, yeah, I got a job, good, you're employed. Excellent. Just what we were looking for. And if you say, no, I don't really have a job, I didn't work for pay in the last 4 weeks, they say, well, did you want one? Did you look for one? And if you say, yeah, I looked for a job in the last 4 weeks, you're unemployed. If you say, no, I didn't work for a job in the last 4 weeks, they say, oh, thanks, bye, you don't exist. You're not in, you're out of the labor force. You're not in, you're not out. Now, we can imagine two problems with that type of figuring out whether you're unused labor resource or not. One problem is when they ask you if you had a job, you could have been working 1 hour or you could have been working 40. Doesn't matter. If you worked 1 hour, if you worked 1 minute for pay, you're employed. Now, the Bureau of Labor Statistics and the Census Bureau that conducts this survey for them, I mean, they're smart folks. They understand this. So they do follow up with another question. They say, all right, you told me you're employed. How many hours did you work? Was it 35 or over or under 35? And if you say under 35, you're part-time. And if you then have identified yourself as part-time, they say, were you part-time because you wanted to be part-time? Or just because that's the only work you can get, or your boss won't give you any more hours? And if you say, yeah, you know what, I work less than 35 hours, and by the way, that's across all the jobs you might have been working. I've worked less than 35 hours in total, and I really wanted to work 40, you become part-time for economic reasons. A term you've probably heard. They also follow up on this other question about did you look for a job in the last 4 weeks? They say, well, okay, you told me you didn't work for a job in the last 4 weeks, and therefore I said you don't exist, but actually I'm a nicer guy than that, so I kind of want to treat you as existing. So did you look for a job in months? Because I'll maybe treat you as existing if you say yeah. And if you say, yeah, I looked for a job in the last 12 months, but not in the last 4 weeks, they throw you in another bucket called marginally attached. Marginally attached means you're kind of in, you're kind of out. And kind of in is really kind of in, because in any given month, about 40% of the people who were marginally attached last month are back looking for a job the next month, and therefore in the unemployment statistics. In and out of existence. So the Bureau of Labor Statistics has said, well, maybe we need a broader measure of how many people's talents we're wasting. So they created this measure called U6, which is basically the official unemployment statistic, and then counts in the part-time for economic reasons, and then counts in the marginally attached. So if you're working part-time and you really want to work full-time, we're going to say you're unemployed. And if you look for a job in the last 12 months, we're going to say you're unemployed. What happens if we plug into this thing the U6 measure, which includes part-time people and marginally attached people? Well, one thing it does is that if you look back before the Great Recession, it did nothing. If you had heard of U6 before the last 6 years, something went horribly wrong with your life. I don't know why you would have known that. Except you had some evil econ professor who made you know it. That has not been true over the course of this recovery. It was even true during the recession, but over the course of the recovery, even though the official unemployment statistic has improved, this broader one, which includes part-time, not wanting to be part-time folks, and I kind of lost the will to get up and look for a job this month, even though I really want a job, folks, they're still hanging around out there at elevated levels relative to before the recession. And you can see that if you use this as a measure of how close we are to zero, how close we are to success, we got a ways to go. And here's what we've discovered. It has to do with this picture. This is a picture of wage growth in wages, by a couple different measures. The blue line is just average hourly pay out of the same statistic that they get the regular monthly employment numbers out of. The other is a thing called the Employment Cost Index. It includes benefit payments, for example, so not just wages. And they are, with a little bit of improvement in the last couple of quarters on the Employment Cost Index, more or less flatlined. I drew a line up here, dash line, something close to what we might think of as normal wage growth. Basically, the rate of inflation we would expect to hold over the longer term, and some guess about the growth of labor productivity. And you could fudge these numbers, 1.4% labor productivity growth, maybe that's a little high, maybe something like 1%. It shouldn't be 2%. It shouldn't even be 2.5%, and these wages are neither of those. And if you do we've done statistical kind of investigations to figure out what looks like it's most related in all these sorts of labor market phenomena we might think of to negative effects, a negative drag on wage growth, is part-time for economic reasons. Keeps showing up again and again and again. That elevated level of U6 seems to be related in some way, I'm not sure exactly how, related in some way to the fact that wages in the United States aren't growing. At least not yet. Now, you can discount that for lots of reasons. One of them is, well, they don't start growing until they start growing. I mean, they pick up fast, and the economy is well on its way to recovery by the time you start to see it in wages. There are lags in the responsiveness of wages to improvements in the economy. Okay, maybe that's going on, but we're certainly not behind the curve, if that's the case. So, that phenomena, one is the great uncertainty that Monet went to earlier, where you've got the experts, the people in the markets, the Energy Information Administration, saying with 95% confidence we can tell you the price of oil will be between $40 and $120. I think those were the numbers. You've got Greece in the monetary union in Europe, maybe in, maybe out, not quite sure. You got an entirely new experiment in monetary policy in Europe that appears to at least be going just sideways. You've got uncertainty about the positives. You've got inflation that the Fed, despite creating a $4.5 trillion balance sheet, can't get above 1.5%. You got wages going nowhere. You got measures of underutilization of labor that are still elevated to anything that we might think of as normal. Probably ought to wait a little longer. How much longer? I don't know. Here's what you should expect. I think that if your expectation is June, you're probably as right as if you said your expectation was December. Think your expectations ought to be, here's my expectation. I'm going to do something I've never done before. I'm going to tell you exactly what I think. And exactly what I think, I don't know. I don't know. I know it shouldn't be today. Do I have any conviction it should be June? None. Do I have any conviction it should be September? None. I think we'll probably find out by the time we get to June how it's feeling, but I can't tell you now. And I won't be able to tell you in March when the FOMC, I won't. Look, Dennis and his colleagues on the FOMC may feel convicted at that point. I'm having a hard time seeing it. For example, between now and March, I kind of made this big deal about the inflation rate and inflation performance. How many inflation reports will we have between now and March? One. We will have one piece of data which will almost certainly be infected with energy stuff. Yeah, I don't know. Besides the issue of when we finally say, yes, we're raising rates, there are a bigger question about the second. Do we raise them by a lot? Well, I think the answer is no, but there is an awful important decision to make about once liftoff begins, once interest rates get off of zero, how fast do they go north? Or even, do they go north? We're completely conditioned by our recent history, in particular the history of post 2001, 2002, 2003 period, where the Fed took its sweet old time raising interest rates, and every meeting it was 25 basis. It was like the sunshine. 25 basis points. Fed meeting today, 25 basis points. Fed meeting today, 25 basis points. On and on and on. Who's to say we don't go a couple and then reverse in the other direction if the data says that's what we should do? This is a committee that has said very clearly we're data dependent. We're not making decisions on anything but while we're reading the incoming. And then finally, what do you think is going to happen to the other interest rates that you probably care more about when the Fed starts raising its rates? Question. What's happened to 10-year treasuries over the past year? Has Fed policy become more hawkish or less hawkish during that period? The answer is more hawkish, and yet 10 years fell precipitously, meaning we can do whatever we want. Someone else is calling the tune on that one. And we don't know what it's going to look like when that time comes. So there, with complete clarity, is my story. Thanks.
The furniture, we only have 10 minutes.
Oh, jeez.
So here's what we're going to do. We have 10 minutes, because we'll take a hard stop. We're not even going to move the furniture. 2 questions. I'll ask, and then we're going to go very quickly to the audience, but you have to promise me the question will come out in 10 seconds. Prepare now. We have a new king in Saudi Arabia. Saudi Arabia is a swing producer. Any sense of change, and what would it mean if we get a change in policy in Saudi Arabia?
Okay, so this is like how Dave ended. The real answer? I have no idea. No. What I know is what they have said, which is they're not going to change. They're going to stick to their guns, and they're not going to cut their production. That's what they have said. But again, as Dave said, they are sort of data dependent too, I'm sure. So that's what they're saying at 15. If it goes down to 20, if the whole, Europe crashes, China crashes, whatever, are they going to stick there? I doubt that very much. But right now, that's their story, and they're sticking to it.
Your forecast is they keep doing what they do.
That's what they say.
That's what they say. Okay, question for Dave. $4 trillion in sovereign debt in this world now trades at a negative interest rate. what does 4 trillion of negative interest rates do in the discussions that you have about Fed policy and outlook?
Well, I mean, the short answer to that is it convinces me, so I will keep it to me.
Speaking only for yourself.
Speaking only for myself, the news and I express. Speaking only for me, it means that it is a very, very, very weak economic environment still, and hence the justification. So here's the question we have to ask ourselves. Why are those interest rates low? It seems very clear. It has to do with global softness. What happens if the Fed raises short-term rates in the teeth of that, tempting an inversion of the yield curve? And my guess would be nothing good.
Okay. Very candid answers we're getting from 2 folks who are kind enough to come. So very quickly, questions. It's got to be fast. David.
Very quick, David. Forecast errors for inflation and unemployment been the same way. You over-forecasted both. A year from now, unemployment's 4.7%, inflation's 1%. Both under what you expect. Does that make the Fed more or less likely to tighten?
Less. So again, I got to be careful. I mean, what I'll say is, what advice would I give my boss? I would say, hey, we way overestimated what the normal rate of unemployment is.
Real quick.
This is a question for Dave. What if you added the deviation from the Fed funds rate from the equilibrium estimate?
The questioner was Bob Eisenbright, my partner from Cumberland, who formerly was the director of research at the Atlanta Fed. This is a rigged question.
Yeah, it is. What happens? So I'm not so sure we've got a big deviation. I mean, I think natural.
The Fed funds right now is relative to where the estimate is of equilibrium?
Maybe not long-term equilibrium, but maybe equilibrium today.
Question there.
Hi, this question is from Renee. You included Iraq and Libya in your estimations for the future, but I was curious how you felt about the sustainability of their growth considering volatility in the regions.
That's very uncertain. I mean, especially for Libya, as I said, they were almost 0, and then they come up to 900, and then they're now to 400,000, so it's very uncertain. And the reason is because of all this political instability and sectarian violence. For Iraq, well, again, no prediction, but it seems it's a little bit more under control than Libya is. So I doubt that it's going to get to 4.5 or even 4, but if they can keep at 3.7, that's still a pretty large rate of growth for Iraq. So again, everything is really uncertain, especially in that part of the world. So it's hard to make any forecasts.
In the back?
So I'm a simple retired person. Simple. In order to get people working, salaries increase, don't you have to help corporations and business? And how do you do that from the federal government?
Well, you ask a question about the federal government, so that's a much broader. So my answer would be you rely on the federal government, not the Federal Reserve. At this point, I think you can count on a pretty uniform response that the Fed has gone all in. It's basically done as much as it can do, and more prompting from monetary policy is not the answer to any question.
Sir.
David, how severe will the damage to alternative energy be, i.e. oil? How severe will the damage be caused by the lower prices in oil and gas? How severe will the damage be
defer
to
to you.
solar and wind?
I'm going to defer to Monet on that.
Well, I mean, the shale boom was not good for, even though the prices were high, but there was so much oil coming out, oil and gas, it wasn't good for the renewables renewables. And now, when it's down to half of what it was, I think it's going to push back some of that renewable growth even worse than it was when you had $100 oil. Not in Europe, though. If you look at Europe, they're going certainly a different way than we are here in the U.S. So they actually are moving out. They're moving out of nuclear, and they have a mandate to go, I can't remember the numbers now, but a big chunk of their energy is supposed to come from renewables. So it's a very different picture there than here. But again, they have no shale over there, or rather than, all kinds of laws against, they're putting all kinds of stuff against fracking, so they're not gonna get that anytime soon anyway. But so very different picture. So not in Europe, because it's mandated to be a certain percentage, and it's a pretty high percentage, even though I can't remember the number right now. But in the US,
Sir?
You indicated that a more hawkish Fed has not produced higher 10-year interest rates, and you suggested, if I heard you correctly, that that indicates that you're not in charge. My question is, who do you think is in charge?
We don't like that question.
Is that a metaphysical question, or? No, look, I mean, in both my answer to David and my answer to Bob, I mean, I clearly think you're looking at a global growth picture, and you can stick Europe, Russia, even China right in the middle of it. There's where the real part, not the inflation part, but the real part of the interest rate developments lie. And, with the only country in the world that is showing any sign of substantial growth is the United States. I mean, it's going in a globalized economy. We're going to see the rebound of that in financial markets, and I think that's what we're seeing.
Let me just mention one other thing. I forgot people, and I couldn't see. In addition to Bob Eisenbeis and Sharon Kazan, Cumberland's folks who are here, John Mousseau, Nanette Sabo, Michael Comas, Daisy Lopez, and Michael McNiven, all helped sponsor this. We have Marianne Waldman on the GIC board from Morgan Stanley Boston, Steve Sexauer from La Jolla on the GIC board with Allianz, Bill Strauss is somewhere from the Federal Reserve Bank in Chicago, GIC, and also NB. I may mix them up, get them backwards. Don Rissmiller, Chief Economist of Strategas, I don't know where he is, in the back hiding. Both GIC board and NB. Ladies and gentlemen, did you like the panel?
Sorry. Great. Didn't know I would answer.
You gave him a warm welcome to come to